Welcome to the Spac Alpha web series. My name is Dan Dombroski, and today my guest is Joe Reece. Joe's a managing partner of Silverbox Capital, and he's also the principal of Boxwood Merger. They're the SPAC that took Analyst Technical Consultants public in 2020, and more recently, him and his team completed the transaction with Black Rifle Coffee just last month. We discussed how his team and transactions came together, evolving deal terms, and transactions from the target perspective. Please enjoy my conversation with Joe Reece. Who do you attribute as having the largest impact on who the man you are today?
Probably, honestly, when I was this is kind of corny, but when I was a senior in high school, I had a civics and a government teacher who pulled me aside and said, "You're an idiot. You need to go to college." And I'm like, "You, I was selling swimming pools. I was making a ton of money in like 1978. I thought I was all that." And he said, "You're an idiot." And so randomly, I literally called the guy about 5 or 6 years ago. And I said, "Hey, do you remember me?" And he said, "Yeah, you were the idiot that wasn't going to go to school." And I literally changed the trajectory of my life. So I've had one or two of those in my life where people have really changed the trajectory of my life. And he was clearly a guy, because I was not going to go to college. I was going to sell swimming pools and live in Northeast Ohio. So
what was your first job?
Well, my first job was, I was a paper boy, but my first real job was selling swimming pools. And I was in high school selling swimming pools, and I made a lot of money on a relative basis. I mean, this is back in like 1977, 78. I'm making 15 to 20 grand a year and selling swimming pools, which doesn't sound like a lot today, but 40 years ago was a lot of money. And this guy just pulled me aside and he said, "Dude, you're going to college. I mean, you're an idiot. You need to be in college." And I'm like, whatever. So he convinced me to go. And then that was sort of just a great transition of my life. So and it's funny that when I called him, he remembered me, which was also gratifying because it was really fun. And it was literally, I graduated from high school in 1979, to give you an idea. And I probably called him, like I said, 5 or 6 years ago, and he absolutely remembered me. It was like, wow. I said, "You really changed my life, and I just wanted you to know that." And he got all teary. It was fun.
Apparently you had an impact on him too.
Yeah, it was really nice. It was nice. I mean, it's nice that he remembered after all these years.
So walking this forward, you've had numerous ventures up until now. Can you walk me through that?
So I spent the first 10 years of my career as a lawyer. I was at the SEC in Washington for 5 years, and then I went to a small New York firm, Skadden Arps, and left Skadden at the end of 96, beginning of 97, and went to DLJ, what ultimately became Credit Suisse, and was there until 2015. Left and did my own thing while I had garden leave. Went over and joined UBS. I ran the investment bank there and was co-head of risk. And after, 20 or 22 months there, I left and hooked up with Steve Goodennessy, my partner at Boxwood. We did our first SPAC in 2018 in November. It went de-SPAC'd and went public in February on Valentine's Day. I think I have a February thing, because then we took our second SPAC public in March of 21 and took Black Rifle public on February 10th. So February has been a good month for us.
So looking at your first SPAC, what did you take away from that transaction?
That's a great question. Steve's heard me, and all of my colleagues, they've heard me say that I've advised on, a few hundred equity offerings, and in particular SPACs. I think all the advice I gave as a banker was wrong. The pipe markets will not be there at all times. In fact, when we took our first SPAC, we de-SPAC'd if there was no pipe market. Fortunately, the folks at Blackstone and GSO came in and partnered up with us and provided some capital that enabled us to close. But what it made Steve and I realize, you absolutely have to have committed capital on the front end, not the back end. And so Black Rifle is a perfect example. For Silverbox, Engaged Capital provided a $100 million forward purchase agreement that we accessed on the back end. There was also no pipe market when we closed Black Rifle, but it didn't matter because we had committed capital. And on the back of the 100, we raised an additional 200 from our own network. We didn't use banks. In fact, I love our bankers at Citi. They did a great job on our second SPAC. I think their comment was, "Geez, there's no market, you can't get this done." And we said, "Well, we're already done." And I think we did it that way because we and I would give Steve credit, the first SPAC, he sort of put it on his back and carried it across the finish line to raise the capital. It was very difficult to do in a market when there is no pipe market. So our thesis is it doesn't matter if there is or is not a pipe market. If you have a good partner with committed capital at the start, when you ultimately find a target and de-SPAC, and you've got capital that you can bring to bear at par, you're just a markedly better buyer. You're going to have a markedly better outcome, and your company will have a markedly better reception in the public markets when it goes public.
So that dives right into what is the structured pipe market looking like right now?
Well, it's very challenging. We talked to so we're working with Citi and Goldman on a couple of projects right now. And so we get the benefit of their knowledge on a pretty frequent basis. And we find them both to be quite constructive and knowledgeable. But I will say that they both are bearish on pipe opportunities. There's a lot of capital that's been committed to the pipe market that has performed poorly. I think we have been fortunate, both of our SPACs on the de-SPAC have performed well. And I don't mean to give too much of a silver box commercial, but according to the latest figures, there's 61 serial issuers. Of that 61, our market performance of our two companies places us as third. I'd like to be first or second, but I'll take third. But the reality is, without capital, if you can't bring capital on the back end, I think it's very challenging to get a pipe done, structure or not. And some of the structures aren't really pipes. There will lend you money for 2 years and you can pay us back on stock sale proceeds, or we'll buy equity, but we need downside protection that's dramatic, or let us put a preferred in that PICs that will consume equity returns. We wouldn't do any of those things. We don't find them constructive for the public markets on a de-SPAC. It doesn't mean they don't have a great spot in the market and they will continue to find investment opportunities. But we like to bring companies to the market that have a capital structure designed to succeed. And we honestly believe the only way to do that is to provide real, firm, substantial back-end committed equity capital, not structured capital, not debt capital. And again, every company's different, and capital structure needs will depend on, is it a growth company? Is it a cash flower? What are the margins like? What's the CapEx? What's the free cash flow conversion, et cetera? So you need to weigh all those things when you put a cap structure together. But generally, we find that bringing capital to bear at the moment of de-SPAC at common at $10 a share is the right thing to do.
And where do you see the best source of this committed capital coming from?
So look, we had a good experience with Engaged. They are a liquid market investor. We're in discussions right now with other potential partners. I don't know that I wouldn't say that there's one or two things that make a good partner, other than the willingness to roll up, their sleeves and be engaged with us. No pun intended. The reality is, when you take a SPAC public, the shot clock starts, and you have anywhere between, in some cases lately, 12 months, which we think is somewhat imprudent, up to 24 months to find and execute a transaction. Our first SPAC we found and then executed and closed in 15 months. That was Atlas. Black Rifle, we found, executed, and closed in 11 months. That is fast, and that requires a very large lift. So the best FPA partners are ones that roll up their sleeves, participate in meetings with us, participate in diligence, and recognize that that shot clock's ticking. And every day that goes by, you lose a day of duration. And I think that's, and that might be a good segue to some of the things you and I have spoken about. There's a very large wall of maturities coming in SPAC land. And I think some of those won't get done because they're going to run out of time.
You bring up that Black Rifle closed in about 11 months, which is incredibly fast. But what do you make of all these sponsors coming out with a shorter duration on their SPACs?
Yeah, so I think my team, myself, we think that's a fair degree of risk you're assuming. That's probably not prudent. Look, I can't speak for every individual sponsor or team. We personally wouldn't do that. Silverbox wouldn't do that. When you think about the time it takes to find and then properly diligence, document, and then execute, go through the SEC comment process. That's, again, Black Rifle, we got done in 11 months. We felt that was pretty heroic. Atlas, we got done in 15 months, which we also felt was heroic. I'll use Black Rifle as an example. We did over 4 months of diligence before we executed the purchase and sale agreement. So we don't believe you should short circuit any of this process to get a deal done. Look, I've run trading businesses and I've run investing businesses. I'm not smart enough to be a trader. I don't want to sit and look at my Bloomberg every day. So when we find a company that we believe will make a good public candidate, we want to invest and keep our money at work, which requires us to do pretty lengthy diligence. We think that 12-month shot clock, Daniel, is frankly, it's fraught with risk because, look, I'm not going to speak for others, but I just think it puts too much time pressure on an individual or a team to find and then execute, to get through the SEC process and get a company public.
So that's looking at the risk, but what's the reward for doing this?
Well, look, the sponsor economics are similar. They've changed slightly with slightly overfunding the trust. I struggle to see the benefit on either side. 12 months we just think is too tight.
Could you give me some background on your team?
Absolutely. We've got a large team actually between our senior members and then our advisory group who actually all roll up their sleeves and work. But the core members of the Silverbox team, it's myself, my co-managing partner, Steve Cadenisi. He's got an operating background. He ran AECOM, a large engineering and technical services firm in New York, based in LA, but with offices globally. Duncan Murdoch, he's our chief investment officer. He came out of Macquarie. He was on the private equity side there, as was Jin Chun. He's our chief operating officer. He's also from Macquarie. He oversaw their Spac platform. In fact, we met Jin because Macquarie was our sponsor on our first Spac when we bought Atlas, and he ultimately decided to join us. We're very pleased about that. And then our chief financial officer is Dan Esters, came out of public accounting and then spent 18 years in investment banking, primarily at Jefferies. So that's the 5 core members, including myself, of our team. Like I said, we've got a large advisory group. I'll give a couple of examples. Tom Warner, founder and CEO of SunPower. He has joined Silverbox full-time. He's in our advisory group. Anytime we look at anything energy transition, we'll go to him. Glenn Marino, GE Capital and Synchrony. Anytime we look at fintech, financials, anything there, he'll jump in. David Palmer, Diamond Resorts, Sunit Patel, T-Mobile. I can go down the list. We've got a very robust team. Everybody that's listed in any of our S1s, they all write a check. We don't believe in having anybody get a free ride. So everybody writes a check, everybody rolls up their sleeves and works. And as a team, the 5 of us that are core, this is our day job. And we are very focused on finding and executing and then delivering good public companies to the market.
What are you looking for when you're building out a team?
Well, first of all, we've got a colloquial no arse rule. Everybody's got to work well together. We like to find people with different domain and different technical skill sets. Great example is, look, I'm a finance guy. I'd like to say I'm not, but I am. My partner's an operating guy. Steve looks at things quite differently than I do, and we're very complementary. You mentioned I'm sort of the quarterback. I'm probably the quarterback on fundraising, capital formation, capital structure, taking companies to market. But Steve's the quarterback on operations, business diligence, organizational structure, organizational design. So that's things that I'm not necessarily good at. So he does that. Duncan's a great chief investment officer. He is super thoughtful, super deliberative. Steve and I look at things and we have comments that day. Duncan will call us back in 3 days and say, hey, I've thought about this. So you need people, we believe, that get along, that share corporate values, that have different skills, whether it's domain or operational, whatever it might be, because the challenge you have in taking a company public through a SPAC, you need 5 or 6 different skill sets and disciplines. It's rare in my mind for 1 or 2 people to have those. That's why we have a fulsome team.
I'll often ask sponsors what they look for out of targets, but to invert this, given the environment, what should merger targets be looking for from their merger partners?
By the way, that's a great question that no one ever asks. I would say there are actually quite a few things, but the things in our mind that are most important first is track record. Have they done it before? it's easy for me to say now, having done 2 as a principal, but I've done many as an agent, and I will tell you it's different. That's the first thing. Do they have a track record of doing it? 2, can they actually help prepare you to be a public company? I gave the example of our team and how we have different skill sets, whether it's the right capital structure, which I would take on, whether it's organizational design and management development Steve could do, whether it's public company reporting that Dan could do. Each of us can bring something to bear to a target company that will make them better than they are on a standalone basis. Not saying because, oh, we're all that, but saying because we've done this before. We know what works. We know what sells in the capital markets, public and private, and we can help you set up to make a better debut as a public company. You'd be surprised how many companies want to go public but aren't really ready to go. And what they don't realize, going public isn't the end of the game. It's the start of the game. It's the beginning of the race. Getting public is one milestone in the life cycle of a successful business enterprise. Quite frankly, unless you're really ready to be a public company, you shouldn't be. And I think a lot of sellers and bankers for sellers advisors should ask first and foremost, what do you, sponsor team, bring to me that makes me better? Do you have operational expertise? We do. Do you have financial expertise? We do. Do you have capital structure and knowledge of capital markets? We do. If you don't have those as a SPAC promoter or sponsor team, those you should, as a seller, quite frankly, you should flesh that out very quickly.
So we've seen certain SPACs trade worse than others, even given the environment. Now, that could be a reflection on the actual operating company, or I mean, it could be something bigger entirely. But when you say market ready, could you elaborate on that?
That's another really good question. So last year, there was a bit of euphoria in the IPO and then the de-SPAC market. And we saw what I think are ideas, not companies, go public. And it's great to finance ideas. Ideas should not be financed in the public markets. Ideas should be financed privately. When you and I were speaking earlier, talking about public company ready, we talk about investing in companies. You need a management team that has a history of execution, that knows how to deliver, that is actually generating revenues, not ideas, that actually have the ability to communicate with analysts, both on the buy side and sell side, that have the ability to forecast and budget based on real operating metrics. We've always said we will not do something pre-revenue as an investment. We will do pre-profit if the operating metrics are good, the gross margins are good, the growth is appropriate. I think a lot of things that traded poorly last year and now were the result of not being public company ready. Again, they may have been an idea that should have been privately funded, or they may have just been a company that in its life cycle didn't have the maturation process in hand that would enable them to be public. I use Black Rifle as a great example. They did $233 million of revenue last year. They have a couple hundred direct digital subscribers to their business. That is a real company. We have worked and continue to work with them to improve some of their operations and their reporting and budgeting, but they were ready to be public. They were not an idea. And it was unfortunate last year. Anytime there's market euphoria, you find money chasing a meme, a fad, an idea, a sector. That's not who Silverbox is. We are very deliberate, very patient. In spite of the fact that we got both of our deals done very quickly, that's a function of having 5 full-time people and then another 15 people in our advisory group looking at deals every day. But that means we're looking to buy a business, not an idea. And I think some of the things that are trading poorly either shouldn't be public because they're not public company ready, or shouldn't be public because they're a great idea, not a great company.
You brought up, you said something very specific, which is the analyst coverage. SPACs as an industry has received a great deal of coverage over the past 2 years, but it seems like they're still lacking that analyst coverage on particular transactions, and even specifically more foreign transactions. Could you speak towards this?
Yeah, so the mistake I think people make, they're focusing on the SPAC product as opposed to the de-SPAC company. When our last SPAC, Black Rifle, we took public with 9 analysts covering that company. I think it's hard to find even a regular way IPO right now that have 9 analysts covering it. I think partly that's because we know what we're doing. We know how to incent and engage bankers and tell a good story that will resonate with public capital markets. But it's not done well, and it should be. And it's critical to have institutional support on the sell and the buy side. And again, that goes back to having a company that's company ready with executives that know how to communicate, forecast, budget, et cetera. If you don't have that, you will fail. Just like if you don't have the appropriate analyst coverage. Black Rifle, a good example, we have Bill Chappell at Truist, who I think is likely the axe in the CPG sector. He's great. And we have 8 other really well-credentialed, thoughtful, good analysts with good II following. You have to have that, whether it's a SPAC or a regular way IPO or a direct listing, you need good analyst coverage on the D-SPAC. And very few people understand that and have done it well, in my opinion.
So what are the mechanics that need to happen for that to change?
Well, if I told you everything that we did, that would maybe take away a competitive advantage. But I think in terms of what needs to change, SPAC sponsors need to better align what they are buying with their target audience, whether they're in CPG or energy transition or technology. They need to make sure they have the right people at the table advising them and getting input and helping them work through the story to make sure it's one that will resonate in the public markets.
Yeah, you spoke about this earlier as well, but how do you see this large class of SPACs or sponsors playing out in this market over the next year or so?
Well, so there are, let me think about this. I think these numbers are accurate because I look at them so daggone often. There are about 298 SPACs in 6 to 12 months that are going to hit their maturity wall. There are 46 that are going to hit the maturity wall in the next 6 months. Combined, that's 99 billion dollars of capital that's looking for a place to work. I think that we are going to see some individuals or some teams not execute and return risk capital. That's an enormous maturity wall. The good news is, look, we're still well off our high of public companies of around 8,000 back in 1996. The bad news is, having, again, pick a number, 298 in 6 to 12 months and 46 in the next 6 months. That's a lot of SPACs. That's a lot of IPOs that would need to get done. And I don't expect they will all get done. I also think that you will start to see people that are running out of duration and they're going to hit their maturity wall. I think you'll see those sponsors start to probably do economically irrational things to try and get deals done, which we think is unfortunate.
And if you had to speculate, do you see that capital being reinfused into other SPAC products?
I spend a fair bit of time talking to institutional investors who are throughout the biosphere of SPACs, whether it's risk capital or IPO capital, D-SPAC pipes, et cetera. I think there's a lot of trepidation in the market right now. First of all, this market's very volatile, between energy prices, inflation, the Fed, the Ukraine, Russia, et cetera. This isn't what I would call a smooth waters or calm market environment. So I think there's a lot of things going on in investors' minds. I do, though, think that there's so much capital that's trying to find a home that won't find great homes. Two things will happen: either A, they won't transact, or B, they will transact on deals that are not, successful for the investors. Our hope is that some of the capital that's remediated or liquidity provided through D-SPACs will find its way to better SPAC sponsors who have a track record with good performance, like Silverbox. Again, not trying to get the commercial, but we also don't think hope is a strategy, Daniel, but as it relates to going public. But we do hope that some of the capital that gets remediated back to investors comes our way, and assuming we do another IPO or two.
And thematically, what are you looking at for the structure of SPACs going forward?
So there's been a few changes as a result of what's happening in the market and the volatility, and quite frankly, the underperformance of so many SPACs. I think you're starting to see more structured capital commitments to actually come in on the front end. You're seeing large institutional investors saying, I'll be a 10% owner, but you need to give me some of your risk capital. And if I redeem, I'll give you some of that risk capital back. That's very structured. I think it's fraught with risk, but I think it's an example of how the market's evolving. We're seeing trusts being overfunded so that investors in the event of a liquidation or in the event of redemption have more capital available. We're seeing shortened duration, which again, you and I have spoken about. We don't think it's prudent, but other people are doing it. So we are seeing the market evolve. And look, we expect the market will continue to evolve. It's a market, markets evolve. Not always for the better as it comes to a sponsor or an issuer, but they are evolving. I think too, when you think about a purchaser on an IPO that asks for founders' economics, but then gives them back if they redeem, that's sort of an illusory purchase, right? They still have the right to redeem, just like you do in a regular way purchaser. But I do think that's a change that some institutions are looking at with underperforming SPAC sponsors, because they view it as a way to protect their downside and get a free option on the upside.
So to piggyback off your liquidation wall comment, we're recording this on March 18th, but so far this month, there's been 6 terminated transactions. There's been only 7 announced and only 4 closed. What do you make of that?
Well, redemptions, minimum cash conditions in merger agreements, market conditions, they're all interrelated. And this is where, again, it helps to understand how the markets work and what the markets will accept. January and December and January, growth sold off, depending on the sector, 20 to 40% in the public markets. It was a veritable bloodbath for growth. There was a very large rotation. And some of those sectors and companies have not recovered. People that priced deals 2 and 3 months ago that had minimum cash conditions based on a pipe raise that can't get those pipes raised, they have no choice but to cancel or extinguish their transaction. Again, that's why, in our view, having committed capital on the front end that you can apply on the back end is the only prudent way to actually be a SPAC sponsor or serial issuer. And what you're seeing right now is people, they have a minimum cash condition they can't meet unless they go to somebody that provides them a structured backstop, which isn't really great equity capital. And that's what we're seeing right now in the market.
So basically, you're pushing anything through just to get the deal done, but it's at the cost on the back end as well.
Well, it is. You get the deal. Getting a deal announced and getting a deal closed are 2 different things, right? It's not easy to do either. However, it is markedly easier to just announce the deal. What we're seeing now, the unwinds that you mentioned, people aren't meeting minimum cash conditions. Why is that? They can't raise a pipe. Why is that? Because they're not understanding what's happening in the broader market, or maybe it was mispriced, or maybe investors just want too much in terms of an economic give up to make it economically viable for either the sponsor or the selling company. So they're all these things are interrelated, Daniel. And I think you trying to be a SPAC issuer without fully understanding the dynamics of, first, just going public, second, finding a deal, and then third, structuring it and financing it appropriately for public capital markets. I just think you do so at your peril. And now you've got companies doing it at their peril if they team up with the wrong sponsor, because you're seeing these unwind happen because, again, they're not meeting conditions to close, so they can't close.
Goes back into a previous comment of looking at the sponsor. There's 5 different components that make up a quality sponsor in your eyes. Could you go through that?
I sure can. There's probably a lot more, but we like to try and distill it down, because if it's more than one hand, I have trouble remembering. First is the ability to develop and effectively mine and prosecute a proprietary pipeline of actionable public company ready enterprises. Second, the ability to fully diligence them and execute on the merger agreement. We spent, in both of our SPACs, we spent 4 months, and in one case longer than 4 months, actually doing diligence, right? Making sure the company had all the necessary successful elements. 3, you have to know how to actually take a company public. That is a little bit of art and a little bit of science, but we think pattern recognition, the fact that we have done so many, matters. 4th, you need to understand how to continue to help the company improve in the public markets. And 5th, you need to help them understand how to communicate, garner analyst support, get buy side and sell side support, and actually continue to communicate effectively in public markets. Look, there's a lot of other things that we think effective sponsors need to do and should do, but those are the 5 critical items. And if you fall short on one of those items, whether it's execution or diligence or targeting, it's not going to be a good outcome. And so we just think part of the reason we have such a large team is everybody brings something different to the table. But each of those things that are at the table are critical for the success of the D-SPAC.
So that kind of sets up for looking at a question that I'd asked earlier of being market ready. So looking at the target themselves, in a scenario where, and I'll drive this directly home for you, if the core values of that company, such as with Black Rifle, are at direct odds that create a controversy, what do you think is an appropriate response from the company, and how well did Black Rifle respond to this?
It's most important to understand what a company's mission really is. And I think that initially plagued Black Rifle. People misunderstood what the company's mission was. The company has never had a doubt what their mission was: to have great product, great merchandise, be very mission driven, and to support the efforts of our military, our veterans, and our first responders. That's not political to me. And I'm a hardcore capitalist, and I'm so grateful that I live in a country in America that has enabled somebody like me, a kid who lived in an orphanage, to grow up and work on Wall Street and have a great career. That's sort of the Black Rifle story. It's mom and apple pie and supporting America. That's not political. It's not left. It's not right. And Black Rifle is the perfect example. Our largest SMSA for sales is New York City. Our third is Los Angeles. I have houses in both, and I can assure you, neither are conservative. Black Rifle is not a conservative company. It's a company that espouses American values and the American dream. And part of, so your question's a good one. Oh, if the mission or the values conflict with what you think the market wants or what other people want, part of it's making sure people understand what a company's mission and values really are. And partly, I think going public has really opened people's eyes to what Black Rifle really is all about. It has nothing to do with politics and everything to do with great merchandise, a great company, great product, great coffee, and supporting people who put themselves on the front lines so that you and I can have conversations like this, right? So that we can live in a great country that gives you and I the ability to speak freely. That's what those values are. And so your question's a really good one, and I'm glad you asked it. This goes back to the ability to communicate, the 5th core need to be successful. You've got to know how to communicate with the market. And if the market misunderstands who you are, what you're doing, there'll be a disconnect on your value. In our latest SPAC with Black Rifle, the market understands now Evan Hafer is literally the American dream. That gentleman started out, he grew up in Idaho, son of a logger. His father's father was a logger, went to college, became a Green Beret, worked for the CIA, and came home and started a great company. That is what that company is. And so it sort of ties into the fifth need, or the 5th requisite skill to be a good sponsor. You have to make sure you're helping whatever company you buy articulate their values, their vision, their mission, their goals, whatever is going to resonate with the community. You've got to make sure you do that well, because if you don't, you know there's going to be a disconnect.
No, Black Rifle isn't occurring in a funnel. So taking a step back from that, how do you see as the most effective method for actually being able to communicate this message? Not necessarily as it pertains to Black Rifle, but is there a playbook? Is it situational? How would you look at this more broadly?
I think it's situational, and I'll use, rather than talking about companies, I'll use industries as an example. Right now, there's a lot of focus on ESG. I'm not sure really, everybody's got a different view on what ESG means, but let's drill down on energy for a moment. And in that context, energy transition has become critical, not just because of the Russian invasion of the Ukraine, but the need to be able to I'm not a climatologist, but battle climate change, the need to have alternative energy sources that are greener. I think right now, energy transition is a broad sector that covers a lot of companies, and it will be critical for any of those companies that want to go public to articulate what their values are, what their mission is, what their path to growth and profitability are. It's okay to be mission driven, but you need to ultimately generate revenues and profit. And it's going to be critical for those types of companies, as an example, to work with the buy side and sell side analysts, to work with their SPAC sponsor, the bankers and the underwriters, et cetera, to make sure that they all understand exactly whether it's a photovoltaic company or a pico nuke generator or a power wall or grid management. They all have a story to tell. They all have mission and values, and they've all got a path to success. It's going to be critical to articulate that so they're not tarred with the, oh, this is just another great idea.
I don't see you riding off into the sunset after this. So what are your plans for the franchise going forward?
We are always looking at opportunities to raise both public and private capital. We will continue to do that. I won't make any comment on any further public offerings for obvious reasons, but we've developed a very good track record issuing SPACs, and I would expect that we would continue at some point to do that again.
Well, I do appreciate you taking the time to speak with me today.
Daniel, thank you. I've enjoyed it quite a lot.